If you've been paying attention at checkout lately, like online or even in stores,
Sure.
you know the whole game is just fundamentally changed.
Oh, absolutely. It's not just swiping anymore, is it?
No, exactly. You're getting all these choices now about how you pay, when you pay, and this whole pay over time thing, buy now, pay later. It used to feel kind of, like a niche fintech feature.
Right, sort of on the edges.
Yeah, on the fringes.
Hmm.
But now it feels like it's moving right into the core, into the main infrastructure of global payments.
And that migration, that shift, that's exactly what we're digging into today. We've got some really interesting source material confirming a pretty massive strategic alignment.
Okay.
We're talking Citi and Mastercard, two giants joining forces to basically embed these flexible payment plans directly into the experience for millions of existing cardholders.
Wow. Okay. So our sources cover what this collaboration actually looks like, how the transaction works for the user.
Yep. And maybe more importantly, what this signals about how the legacy players, the big banks and networks, are responding to this whole BNPL wave.
Right. So this deep dive is kind of mapping out the future battlefield for consumer credit, in a way.
I think that's a good way to put it. And it's important to remember the roles here. You've got Citi, the issuer. They own the customer relationship, the credit line, and then Mastercard, the network. They control the rails, the pathways the transactions run on.
So when those two team up on a new product...
It's big news. It's potentially a seismic shift.
Okay, let's unpack the structural shift then. So
Yeah.
let's start with the basics, the announcement itself. What exactly is happening?
Okay, so Citi is taking its existing pay over time solution, which is called Citi FlexPay.
Right, I've heard of that.
And they're enabling it so it can appear directly at the point of checkout. And they're doing this by officially joining Mastercard's Installments payment services platform.
Gotcha. And the timing.
Well, this was announced late October 2025, and they really emphasize speed. The plan is, or was, to have this available at participating Mastercard merchants by the end of that same year.
Wow, that's quick for something this big.
It is. It really shows you how urgent they feel this is, capturing that installment market.
And there's a key detail about Citi's role here, right? Something about being first.
Exactly. The source material highlights this. Citi is the first major issuer to officially join Mastercard's platform for this specific capability, this deep integration at checkout.
So they're not just following a trend, they're trying to actually lead the mainstreaming of it.
That seems to be the goal, setting a standard, maybe. The official line from the press release talks about bringing more access to flexible payments directly at checkout.
Creating a seamless experience.
Creating a seamless experience for customers and retailers alike. And yeah, seamlessness, that's like the holy grail in payments now.
Seamlessness is definitely the word. Okay, so let's shift from the corporate strategy. Let's get practical for the listener.
Yeah.
Someone holding a Citi card. What is Citi FlexPay, really? And how is this different from maybe how it worked before?
So Citi FlexPay, it's essentially a feature that's already built into your existing Citi credit card. It's not a separate thing.
Okay.
And it lets you take a specific purchase, an eligible one, say. You buy a new TV for $1,500.
Uh-huh.
You can choose to split that specific transaction into fixed monthly payments. With a set duration, a clear interest rate, perhaps.
Right. But typically when we think BNPL, we think, okay, I have to leave the checkout, maybe go to a third-party site or app, sign up, get approved for a little loan. Maybe there's a credit check involved, even a soft one.
Mm-hmm.
How is this FlexPay integration different? Where's the efficiency?
That efficiency, that's the absolute key differentiator here. And it's kind of the genius of this issuer network link up.
How so?
Because Citi already knows you. They know your credit profile as their cardholder.
Mm-hmm.
So this installment option needs no extra application. Nope. No setting up a new credit line. And crucially, no additional credit checks right there at the point of sale.
So you're just using the credit limit you already have with Citi.
Exactly. You're using your existing credit worthiness.
That takes out a huge amount of friction for the person buying something.
Absolutely. So imagine you're at a participating retailer and they mention categories like, electronics, jewelry, maybe home furnishings, the bigger ticket items.
Right.
You'll just automatically see the Citi FlexPay option there, right next to the choice to pay with your Citi card normally.
So it feels more like just another way to use your existing card, like an upgrade option, rather than applying for a whole separate loan.
Precisely. It's instant approval, basically, because it's built on that existing relationship. That whole underwriting step, gone from the checkout moment.
Which must be great for the retailer too, right? Fewer people dropping off because the application is annoying or takes too long.
Definitely a win for conversion rates, speed, convenience. It ticks those boxes.
Okay, but hang on. If FlexPay is just using your existing credit line, does that mean the interest rates might be different? Maybe. Potentially higher than some of those zero-interest deals you see from the pure BNPL companies?
That's a really sharp question, and yes, it's different.
How so?
Many of those third-party BNPLs, especially the ones offering 0% APR for short terms, they make their money mainly from fees charged to the merchant.
Right.
FlexSwitch, however, operates more on the traditional credit card model. It offers fixed payment plans, yes, but the interest rate, the final cost to you, the consumer, that depends on the specific terms Citi offers for that purchase based on your existing card agreement.
So it's not necessarily zero interest.
Not necessarily, no. It's bringing the structure of installments, the fixed payments over time into the credit card world. The trade-off for the consumer is you get super high convenience, security from a trusted name, but potentially higher interest costs compared to the most promotional, maybe introductory BNPL offers out there. It's flexibility, but tied to traditional credit economics.
That's a really important nuance. Convenience and security versus potentially the absolute lowest cost. Okay, got it. Let's zoom out again. This integration, it's obviously not just Citi wanting a better feature. It says a lot about MasterCard's broader strategy, doesn't it?
Oh, absolutely. If we connect this to the bigger picture, this is MasterCard reacting strategically. You could even say existentially.
To the BNPL threat.
To the whole shift in consumer preference.
Yeah.
One of their executives, Seema Chibber, is quoted mentioning an explosion in the preference for installments. They see it. They can't ignore it.
And I guess more critically, they can't afford for all these installment payments to happen off their network, right? If I use some standalone BNPL app that settles differently, MasterCard doesn't see that transaction.
You absolutely hit the nail on the head there. They lose the transaction volume, and maybe more painfully, they lose the interchange fees associated with it.
The fees.
Protecting the network, keeping transactions flowing through their rails, protecting that interchange revenue, that's a massive driver here.
So their strategy, which they talked about before this Citi deal, it's basically to pull installment and BNPL features into their own infrastructure.
Yes. Embed them so deeply that MasterCard becomes the essential backbone for any kind of pay-over-time solution, no matter who's actually providing the money behind it.
So stop fighting BNPL as just a competitor and start treating it like a type of transaction they can manage and will monetize.
Pretty much. Control the pipes, like you said.
Oh.
They're investing a lot in capabilities they describe as versatile. What that means is building an experience at checkout that works smoothly, whether the installment plan is funded by a Fintech BNPL provider, maybe even a debit-based solution, or a traditional bank's credit program, like Citi FlexPay in this case.
Versatile. That sounds complex, though. How do they make it feel the same at checkout if the money's coming from totally different places?
Well, that's the power of the network infrastructure they're building. They're creating the technical connections, the APIs, the standards, so that the retailer, the merchant, ideally only has to integrate once with MasterCard's system. Then MasterCard handles routing it correctly, verifying things, settling the payment, regardless of whether you chose an Affirm option, a Klarna option, or now a Citi FlexPay option if you follow.
So MasterCard becomes the universal translator almost for installments at the point of sale, making the funding source kind of irrelevant to the merchant's tech setup.
Exactly. They handle the complexity behind the scenes.
That unification, that's a powerful position to be in. It means all those existing cardholders, people who already trust MasterCard security, they now get this added flexibility easily. And here's where it gets really interesting, I think.
Go on.
By teaming up with Citi first, MasterCard instantly brings this flexible, secure payment option to millions of people. People who don't need to download a new app, sign up for anything, or go through any extra hoops.
It's instant scale, massive scale, overnight. And that trust factor you mentioned. The MasterCard exec specifically said this gives customers the same peace of mind as their other MasterCard products.
Right, the security expectations.
That established trust, the security protocols people are used to. That's a huge advantage that, frankly, newer third-party BNPLs have to work much harder to build.
So it shifts the fight, maybe. From just being about easy sign-up, which BNPLs were great at, back towards trust and established credit relationships.
I think that's a very good way to see it. It leverages their core strengths.
And this wasn't totally out of the blue, right? They laid some groundwork for this capability before the Citi announcement.
That's right. This wasn't day one. It builds on work they announced back in October 2024, I believe. Their plan then was to expand their U.S. Installments payment services program across basically all eligible digital checkouts.
Okay.
The Citi partnership is like the big visible proof that the system works, it's ready, and it can handle integrating with a major bank. It's like hanging out a sign saying open for business to all the other issuers.
This has been, really insightful, seeing how the big established players aren't just, running scared, but are actually integrating these new trends right into their own models. Okay, let's try and synthesize this. 2 key takeaways for you, our listener, about why this Citi Mastercard link-up really matters.
Okay. First takeaway. I'd say we're seeing a fundamental shift in what a core credit card service even is. BNPL, these installment features. They're moving from the edge to the center.
Right. Not just a nice to have, but becoming expected.
Exactly. Becoming almost a mandatory feature for the big networks. They're essentially co-opting the innovation that the fintechs pioneered.
Okay, that's one. What's the second?
Second, Citi being the first big bank to integrate its existing credit product, FlexPay, right into the Mastercard network checkout flow, that provides a clear path, a blueprint for all the other major banks.
How so?
It shows that these huge institutions can use their existing scale, their established customer bases, their existing credit lines to meet this consumer demand for installments really efficiently without having to invent totally new standalone products necessarily.
So they can leverage what they already have.
Precisely. The game now seems to be about integration, using that existing trust and deploying it at massive scale. The nimble fintech innovators are now facing the fully awakened giants, so to speak.
So what does this all mean when we boil it down?
Well, this new setup lets a major bank offer installment plans instantly, right at checkout. Plans that are trusted, built into the cards people already have, and crucially, without needing extra applications or credit checks at that moment. That combination, the seamlessness, the scale, the embedded trust, it's pretty powerful.
That level of efficiency, reaching millions of cardholders almost immediately, it really does raise a fascinating question about where payments go next.
It really does. Okay, so here's the final thought, the provocative question for you to mull over.
Let's hear it.
If these huge issuer network partnerships like Citi and Mastercard can offer these super smooth embedded installment options using their vast existing credit infrastructure and customer trust, how do the traditional third-party BNPL providers, the ones often relying heavily on merchant fees, maybe still building that widespread consumer trust, how do they compete long-term? How do they defend their turf against the sheer gravity, the sheer scale of this newly integrated traditional credit system offering the same flexibility?